Well, when we started out this paper, it came about partially because of the financial crisis and the idea that it became obvious. One of the things that we talk about in corporate finance is this idea of what is optimal for firms to undertake when it talks about capital structure, their balance sheet. And in that, we typically talk about leverage and we talk about cash holdings as part of this. However, there wasn't enough emphasis on kind of refinancing risk. Was this idea that you could take two firms that were exactly the same going into the financial crisis, and there was no difference between the two of them. However, one of them had their debt that was going to roll over during the financial crisis, and the other firm might have the situation that they rolled over their debt a year before the financial crisis, or they had to roll it over 2 years after the financial crisis. And the outcomes for these two different firms were dramatically different. All of a sudden, their refinancing just came to the end. So based upon the risk of the firm, if they were anything below triple B, and if they fell into what would be considered junk or high yield, they just couldn't refinance their debt. And they had to make some very, very difficult choices. Some of them went into bankruptcy. Other firms had to cut back on their investments that they were making for the future, which has a long-term impact on the firm. So this was the idea that we were trying to document this. And what we find in the paper is that the managers of companies are pretty darn smart. And what they have done and what we documented is that their refinancing risk over the last 30 years, we've seen how we document refinancing risk has gone up significantly for firms. However, what they've done to offset that is they're holding more cash than they used to. There was a very famous paper out 4 years ago that was saying, why are firms holding the amount of cash that they are? Because from any of our models, it was not optimal, the amount that they were actually holding. And we show actually from the firm's perspective, it is optimal given that their refinancing risk, has changed over time. And that was the general, idea behind the paper of going out and documenting it. So in the process, what we did is we documented that cash holdings have gone up, which has been shown before. We then went and took a look at how refinancing risk has changed over time, and that's increased dramatically. And then we had to link these two up and show that one was causing the other. And this is very difficult in the research. This is not about, well, these two things are related, which we would call correlation. But we have to actually prove causation, that the change in the refinancing risk directly led to changes in cash holdings. And that was the main gist of our paper. Well, we always talk about if holding a lot of cash, we can talk about Apple as an example. Apple holds a lot of cash, and you become a target in many contexts for activist investors, some type of outside investor trying to take over the firm, because part of the financing, when you think that I can go acquire this company, and if I have to pay, say, $10 billion for it, but the firm has $3 billion of cash on the balance sheet, I can take that $3 billion to help pay off the amount that I actually have to finance it. So holding excess cash makes you a target. The idea of finance is what we're trying to do when we talk about, what is optimal in the cash holdings. From a finance perspective, we always want it to be the absolute minimum amount possible. Because what we're going to say is well, how is this firm doing? We're going to take a look and say, well, how much cash are they generating every year relative to the amount of investment that they're making? And one of the investments, we say the total amount that you have invested, that includes your cash. So if you can go back and you can pay out your cash, get rid of your cash, and I have the same level of return with a lower investment because I have less cash on the balance sheet, I'm going to get a higher rate of return. And in finance, that's what we're looking for, is that high rate of return. So the idea is that when things are going great, we look at cash and say, wow, we don't need it. But when all of a sudden you're in a financial crisis or there's a downturn or something happens to the firm that they're in trouble, then the old adage that cash is king comes back. So this idea of how much you should hold in cash can change based upon where we are in kind of the financial cycle and where a firm is. So the cash is a cushion, and sometimes that cushion is a bad thing. You can have too much of a cushion, you can be too cautious, and then on the other side, having that cushion is beneficial if you're going through a bad period of time where you do not have the ability to access outside capital. If you have cash on your balance sheet, you can allow the firm to continue to make investments, which investments for firms pay off years in the future. So sometimes you're trading off this short-term benefit for this long-term benefit. And so that's what we're trying to balance when we say, okay, what is optimal? You have to balance these two different aspects. And to understand that balancing aspect, we have to understand how all these decisions are intertwined and then break those up so that we can make some comments about what is optimal for a firm to do. Well, in the cash holdings, there are a couple divides that fall out. In the idea of, for a firm that is, let's say, the highest rated, a AAA firm, that for them cash, they don't need to hold a lot of cash. Okay, and if you look at firms that hold very low levels of cash, a AAA firm holds very low levels of cash. The reason for it is that firm at any point in time can access the capital markets and get cash like that. There's absolutely no problem for them. As you fall down, as you go lower, you have higher risk, so you have the leverage in the capital structure, so you're trying to say, okay, here's the cash flow. If we lower the amount that's invested in the equity, we can boost the return. But what happens is you fall down and you get lower and lower on the leverage, you will find that firms are holding more cash because when there is some type of financial crisis, and it seems to be that every 5 to 7 years there is some kind of financial crisis. We don't know what it's going to be, but there will be one. And in those periods of time, the firms that if they're down, especially below what would be considered into the non-investment grade or high yield or junk bond, whatever you prefer to call it, space, that during those periods of time, a firm cannot access the capital markets. So, and this is what we're talking about when we talk about refinancing, is that typically what will happen is if you have a firm and it has, let's say, $1 billion of debt outstanding, typically that means it probably has two 10-year bond issuances, $500 million and $500 million. And what will happen is when that bond is maturing, so it has a 10-year maturity on it. I issued it 10 years ago. It comes up, it matures. What happens on the date of the maturity is that it's rolled over. Firms never pay off that debt. What they do is they go back to the capital markets. They issue another $500 million bond. They take the proceeds of that to pay off the old bondholders, and then they start again. So what will happen with the refinancing risk or during the periods of financial crisis is that, okay, I have that bond that's coming due that I'm going to refinance, and all of a sudden you can't. When there's a financial crisis, if you have too much leverage in your capital structure, or maybe not too much, you have a lot, it's hard to say what's too much or not, then that firm will not be able to refinance, and it's got to make some very difficult choices at that point in time. Well, I think what we're trying to do here is to show that what has happened in corporate finance and how we talk about it in our classrooms and what we talk about this with companies, I think has changed over time. And very recently, we've got into this idea that typically you go into a classroom and I will tell you, let's talk about an optimal leverage for a firm. Let's talk about optimal cash for a firm. And let's talk about the optimal term structure of debt, which is when do your bonds mature? And we would talk about each of those separately. The takeaway from this paper, and I think the first along the path, is a deeper understanding of saying that when you make this choice, you cannot talk about just one thing in isolation. we can't talk about an optimal leverage policy without talking about an optimal cash holding policy and an optimal refinancing policy. And so the takeaway from this paper is to talk about all three of these at the same time, and to say that they're all jointly determined. And when a firm is making these choices, that they have to think about all three of these aspects as one question and not three separate questions. That was the main takeaway.
Anything else you want to add that you think is critical to anybody who's reading this research?
No.
No?